Dear friends, welcome back to PMS Insights. In the run-up to the general elections, the government was widely expected to announce a populist interim budget after losing state elections in Rajasthan, MP and Chhattisgarh. However, considering the budget stuck to the fiscal deficit range of 3.4% both in FY19 and FY20, it can be considered to be a prudent budget focusing on the middle class, rural and unorganized segments. Also, while the GST collection projections look optimistic, which will need improved tax compliance, the same gets offset by the conservative direct tax growth assumptions, making the overall fiscal math believable. The two major proposals of the interim budget were related to the direct benefit transfer to the marginal farmers and income tax rebate for income up to Rs 5 lakhs. Both these measures cumulatively amount to Rs 1 lakh crores of additional income in the hands of farmers and middle class taxpayers. It is very likely that this amount finds its way into consumption-oriented spending. We expect the consumer staples, durables and discretionary companies with higher exposure to rural areas to benefit disproportionately. We believe our portfolios are appropriately positioned to benefit from this, with around 60% plus exposure to consumption sector and retail financing companies. Encouraged by the government's prudent stance in the interim budget and low inflation expectations, the Reserve Bank of India has slashed the repo rate by 25 basis points and also changed its stance from calibrated tightening to neutral. This shows the renewed focus on growth by the new RBI governor, along with keeping tabs on inflation. Also, the Reserve Bank of India reduced risk weights on the bank lending to NBFCs, thereby ensuring improved liquidity in the system, benefiting the better managed NBFCs. This again would bode well for the NBFC sector exposure in our portfolios. The ongoing earnings season has been a mixed bag so far, with companies reporting above estimate sales growth. However, the profit margins have seen compression due to increased material cost. Our portfolios benefited from exposure to sectors like retailing, which showed strong growth. Also, the IT services companies in our portfolio did well with decent sales growth and may benefit from ongoing currency weakness. The private sector banks with both retail and corporate focus too have performed well in the last few months on the back of higher growth and lower NPA accretion. On the other side, exposure to auto sector and some stock-specific issues have contributed negatively. However, having done the necessary adjustments to the portfolios, we expect the portfolios to perform well in the near to medium term. While the domestic events related to budget and policy rate cuts have been positive, the global factors related to US-China trade war, slowing global growth, withdrawal of monetary stimulus, and weak commodity prices are potential risks. Also, from the Indian market's perspective, the upcoming general elections are keeping the investors worried. Interestingly, if we analyze the market performance around past general elections, markets have actually performed well during the 6 months prior and post-election period. While one cannot rule out market correction if there is a fragmented mandate, we believe that over the medium term, the basic growth drivers of the Indian economy will drive stock returns rather than any particular government coming to power. I would like to end this talk with a quote by Thomas Phelps. To make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them. Patience is the rarest of the three. We believe that investors who remain patiently invested in current uncertain times would stand to benefit over the next few years. Thank you.